Hello, everyone, and thank you for joining us for this CSA educational webinar on private pay funding options for senior care. Chris Orestes, CEO of Life Care Funding, is an 18-year veteran of both the insurance and long-term care industries. A former Washington, D.C. lobbyist, he is a nationally known senior care advocate and author of the Amazon bestseller book, Help on the Way, a legislative expert, featured speaker, columnist, and contributor to a number of insurance and long-term care industry publications. Chris is a frequent guest about senior issues on national radio programs and has also been featured in the Wall Street Journal, New York Times, USA Today, Kiplinger's, Fox Business News, and PBS. Please welcome Chris Orestes.
Well, thank you very much. And thank you, everybody, for taking time out of your day to join us to discuss this topic. As it was mentioned, I am Chris Orestes, and I'm the CEO of Life Care Funding. And our company was founded in 2007 after my career in Washington, D.C., to help families address the income gap in paying for long-term care. Now, what our company specializes in is a specific area that we had noticed was a big area that was being overlooked by seniors as a way to pay for care, and that is using a life insurance policy that can be converted to pay for any form of senior care by turning a life insurance policy into what's known as a long-term care benefit plan. And that can cover home care, assisted living, skilled nursing, and hospice care. So that's an approach to long-term care funding that we brought into the market back in 2007. And today, we work with a network of senior care providers, assisted living companies, home care companies, nursing home companies all over the United States, about 6,000 or so that use our program, insurance agents, advisors, elder law attorneys, CSAs that work with our program. And what I want to do is spend some time today talking about not just what we do, but the variety of private pay funding options that are out there in the market, and the lack of understanding by families, by care providers, and by advisors about this mix of funding options. And this is an important topic because we've got a big problem in this country, and you should all be, and I'm sure you are, well aware of it, and that is one that's talked about in the press. It's talked about in political circles. It's confronted by families every day, and it's how are we going to, as a country and as families and individuals, pay for long-term care services. The costs of long-term care are astronomical, and on an annual basis, rising 3 to 5% a year. The costs of nursing home care, assisted living care, home care, hospice care are on the rise, and it's a big challenge that families face from a standpoint of how are they going to afford it. But an even bigger problem for families and for advisors is the fact that people are so unprepared for long-term care. They're uninformed, they're unprepared, and what's making the problem worse every day is the fact that 10,000 baby boomers a day are turning 65. And it's a well-known fact that at least 70% or more of people 65 and older will need long-term care services in their lifetime. Too few people understand the differences between things like Medicare, Medicaid. What's the difference between assisted living, skilled nursing, and so too often wait until they're in a crisis situation before they start trying to figure these things out, which, as we all know, is the worst possible time to try and figure this stuff out. Now, for many people, what they'll do is, and for many advisors, they'll look at Medicaid as the first option, but Medicaid is the last option. Private pay is the first option that people should be looking at, because to qualify for Medicaid, to get Medicaid coverage from long-term care is not easy, and it's not a given. You have to meet the medical necessity requirements. You have to meet the income asset levels below the poverty line. You have to be cognizant of asset transfer rules. You have to understand what is and what is not qualified in terms of a spend down, and be within that 5-year look back. And when it's all said and done, middle-class Americans don't want to impoverish themselves to become a ward of the state and go on to Medicaid, and in so doing lose their choice, lose their options for where they want to be, what kind of care they want to receive. Now, as part of the long-term care planning process, you have to be aware of the liabilities that are out there, because There are government mandates to claw back funds from families. If there are assets that are available and somebody goes on to Medicaid, there are asset recovery rules that dictate families are actually taken to probate court and sued to recover available assets to get back, claw back the money that Medicaid spent on their care. In over half the states of this country, there are also what's known as filial responsibility laws that are on the books that will hold family members responsible for paying for care. And I'll give you a recent example. Just a couple of years ago, in Pennsylvania, there was a high-profile court case where the Superior Court of Pennsylvania found against the son of a woman who had moved into a nursing home. She had been there 6 months, and her Medicaid application was denied. So in the 6 months she was there, she had racked up a bill of $93,000. Her son was taken to court and held responsible and had to pay that upon her departure from the nursing home. With that unpaid amount of money, he had to come up with those funds and was held legally responsible. Now, there are court cases like this all over the country that advisors need to be aware of. As I said, over half the country, half the states in this country have these kinds of laws on the book, and it's a federal mandate across the country that asset recovery action needs to be taken when there is the potential to recover what Medicaid spent on somebody's care out of assets that are available. Now, there's a political reality that you all need to be aware of, and families have to understand that is driving very much of how long-term care is going to be funded in this country today and going forward. Just in the summer of 2013, the Commission on Long-Term Care met and in 2014 released their report on the future of Medicare, Medicaid, and its impact of funding long-term care in this country. And the predictions were quite dire. The chairman of the committee, everybody across the board involved in that report was unanimous in pointing out that Medicare and Medicaid alone is not going to be able to sustain the growing population and demand for long-term care services. And at a political level, there's a lot of movement now towards private pay funding, how to encourage private pay. And I'll give you a couple of examples. Over the last few years, and this is some actions that we've actually been involved in, life care funding. We've been called in to testify, give expert testimony on ways that we've helped keep families private pay and delay their need for going on to Medicaid. There are actually laws being introduced in states all over the country mandating disclosure about private pay options. About if somebody has a life insurance policy, they need to be told it's something they could use to stay private pay. There's all kinds of attention on veterans benefits, on reverse mortgages. So there's a lot of political support and political pressure to encourage the use of private pay and to try and delay the need for people to go on to taxpayer-funded programs like Medicare and Medicaid. There's also a lot of attention in the press. There have been a lot of stories written about in major publications, New York Times, Wall Street Journal, USA Today. What are the private pay options? What are the pressures on Medicare and Medicaid? And you, as advisors, it's important you're aware of these types of solutions that exist in the market. It's important from a liability standpoint. You don't want to advise somebody who comes back to you later and says, you did not give us a full sense, a full picture of what was out there. You gave us only a partial solution. You didn't give us the full solution. Families have sued advisors for after the fact coming back and saying, you didn't tell me about all my options. And this is a list of private pay funding options that you want to be aware of. You want to take some time to get to know each of these because these are actively out there in the market. Many assisted living communities, nursing homes, home care companies offer in one way or another or accept these types of payment options. And you want to be in a position to, at a minimum, be aware of them, have some level of understanding of how they work. If not, endeavor to become an expert in these to the point you can give some good advice and at least point somebody in the right direction, having given them a full scope of what their potential options are from which they can make well-informed decisions. let's start by looking at the Veterans Aid and Attendance benefit. Now, this is a benefit that will provide for a veteran of actual active combat duty and or their spouse upwards of $2,000 a month directly paid towards long-term care costs. Now, it is an engaged process to qualify for this benefit, but for veterans, this can be an important piece of the puzzle to help them pay for care. But I do want to point out that the Veterans Administration now is proposing and most likely to pass a rule change that is going to include a 3-year look back before the end of this year on applicants, and it's possibly even going to be a retrograde look back for current recipients of the VA benefit, but similar to how Medicaid has a 5-year look back period, the VA is most likely going to institute a 3-year look back period. So as you look at the Veterans Aid and Attendance benefit, you want to be up to speed on what's coming with these potential rule changes in the not too distant future. When it comes to reverse mortgages, this can be a good solution for a homeowner because they're able to take money out of their equity without losing title of their home. They don't have to pay it back while they're alive, but there are a couple of caveats to using the reverse mortgage as a tool to paying for long-term care, and one of them is to qualify for a reverse mortgage and to stay in a position where you don't have to pay the money back, you have to be living in the home. So for a possible use to fund home care, this might be a solution, but if the situation were to get worse and it became necessary to move out of the home, this actually could become problematic. So when somebody uses a reverse mortgage as a tool to fund long-term care, you need to be cognizant of that specific rule that the person has to be living in the home, because once they're out of the home or they pass away, the reverse mortgage does have to be paid back, which is typically done out of the sale of the home, and it will cover the principal, the interest, closing costs, fees. So it's not an inexpensive proposition when it is all said and done. There are also what's known as senior living loans, and these are loans that can be taken out without collateral. These are not bank loans. These are provided by a third-party lending institution that will specialize in what's known as a senior living loan to help pay for senior care costs, particularly assisted living or home care costs. These are not secured by collateral, as I said. They are actually secured by co-signers. Family members will co-sign on the loan, guaranteeing the loan, and you can have multiple family members, as much as 6 family members can co-sign on these loans with interest rates that are in the range of a credit card. They typically are for a term of a max of 3 years and would pay directly, not to the individual, but directly to either the assisted living community or the home care provider. Now, long-term care insurance has been one of the long-standing private pay funding options for care. It is, though, something that you have to purchase many years in advance. The typical purchase of a long-term care insurance policy is oftentimes in your 40s or 50s while you're still relatively young and healthy, so you would need to be in a position to be able to continue to make those premium payments to keep the policy what's known as in force. It's active, and you don't want it to lapse by not paying premiums, and that can be for decades. It's not inexpensive, but there are numerous options and ways and different types of long-term care insurance. So if you're young and you're healthy, that's the time to buy long-term care insurance. Some people make the mistake of thinking they'll wait till it's time to move into a nursing home and then they'll buy long-term care insurance. And that's sort of like waiting until your barn burns down to go buy fire insurance. It's too late. So that's something that has to be planned for well in advance, and financially, you have to be prepared to carry a policy for many years. Now, there's another option in the marketplace involving insurance, and this is what's known as a life settlement, or sometimes it's called a viatical. This is the sale of an existing life insurance policy to a third party who is going to buy that policy for a discount of the death benefit. So, for example, a $100,000 life insurance policy might get somebody $20,000 today they're going to sell the policy to a third party who's going to take over the premium payments, and they're going to own that life insurance policy. And years in the future, they will collect the death benefit, the $100,000 death benefit. And the way they make money in this kind of a transaction is they're hoping that they'll time it right, so whatever they've paid to the original policyholder plus the premium payments and any other costs and expenses associated will by the time the person dies and they collect the policy, there'll still be something left for a return on their investment. It's a transaction that's regulated throughout the country on a state-by-state basis, and for agents who want to be brokers of life settlements, they do have to have insurance licenses and specific brokerage licenses on a state-by-state basis that they would need to review with their specific state insurance department. Now, another insurance-related or financial-related vehicle is what's known as a SPIA, or a single premium income annuity. And this is an immediate annuity contract that somebody with a large sum of money, a relatively large sum of money, would put into the annuity, and it would, to make it Medicaid qualified and avoid it being considered an unqualified asset transfer, the annuity is going to go into the name as an investment of a spouse. But the annuity itself has to be set up so that the state is named as the remainder beneficiary, so that when the person passes away and they had Medicaid supported care, then the annuity will pay back the state the Medicaid portion that is due to them. Very similar to an asset recovery action, although it's set up specifically in the annuity contract. And by setting it up this way, it avoids being a disqualifying event for Medicaid eligibility. Then lastly, I'm going to point out what our company specializes in and what we pioneered and brought to the marketplace and turned into very much a mainstream funding option offered by assisted living companies, home care companies, nursing homes all over the U.S. is what's known as a long-term care benefit plan. A long-term care benefit plan is the conversion of an in-force life insurance policy of any type, a term life policy, a universal life, a whole life, a group life, any kind of life insurance policy can be converted into an irrevocable FDIC insured benefit account. It's a bank account that holds the sum of money that is whatever is the discount on the death benefit. And again, in this type of a transaction, an unneeded life insurance policy is being sold for a percentage of the death benefit, usually between a low of 20% to a high of 60%, times even more of the death benefit is put into an irrevocable FDIC insured benefit account, where the funds then are immediately available and make tax-free payments on a monthly basis to whatever form of care a person chooses. So again, being a private pay tool, a person who would use a long-term care benefit plan option, instead of lapsing or surrendering a life insurance policy, would be able to turn it into a vehicle that is a protected account holding money that, because it's spent on senior care services, is tax-free, and they can choose any form of care they want immediately. So home care, assisted living, anything somebody wants, they can choose. And if they need to move from one form of care to another, they can. This is a much less restrictive option than, say, long-term care insurance, where to trigger the policy's benefits, there's some pretty significant hurdles and qualifications that have to be met. This is a much more flexible and quick to access program for somebody who has a life insurance policy. Now, what all of these programs have in common is, because they're private pay, they are allowing the person to choose the form of care they want. And this is really a matter of dignity. You're allowing for choice, and you're allowing for dignity for your loved one, for yourself, because as private pay, it's up to you. You can choose where you want to receive care, who you want providing your care. If you're on Medicare or Medicaid, you do not have that same freedom of choice. You are within a certain geographic region. You have to go to certain approved Medicare, Medicaid qualified care providers. You have to meet medical necessity standards. You have to meet income asset standards, age standards. So When you're private pay, none of that applies. You are the boss, you're making the choices, your clients are making the choices, you're helping them stay in control, which is the number one thing seniors and families want. They want control. They don't want to lose control when they enter into a long-term care situation. And the other thing that all of these programs have in common is all senior care providers across the United States accept private pay and in fact prefer private pay, and in fact many require private pay. Private pay is really the ticket to being able to walk into any senior care environment you want, because when you're private pay, you are the most desirable form of patient resident for care providers. That is always the preference, private pay. So in conclusion, I just want to point out a couple of things. One, the problem that you are helping families overcome, and the problem that this country faces is people are unprepared. They're uninformed. They're looking for advice. They're looking for guidance. It's a topic that people avoid most often until they have no choice. They're in a situation, they're in a crisis, and they have to deal with it. And you as CSAs are in the best position to be able to give that kind of impartial advice. The trick is to be able to make sure that you are aware of all the options that are out there, that you're not leaving something out of the equation, because if you are, you're doing a disservice to your clients, and you're also exposing yourself to potential liability that you don't want to be in a position of being exposed to. Remember, seniors want to remain financially independent and in control of their care decisions. They don't want to be a financial burden on their families. They don't want to go on to Medicaid and be a ward of the state. If they can stay private pay and choose the form of care they want, that is by far their preference. The solution in the market is that there are numerous options that are available for people to remain private pay, and the trick is for you to be up to speed on them so that you're helping families make well-informed decisions. Because at the end of the day, there's a great benefit to the consumer, to the provider of care, and to the taxpayers. For the consumer, it's the option that they can choose to use assets, savings, investments, insurance products that they already own, that they already have access to be private pay, and put themselves in that position of choice and control. For the providers of care, as I said, they prefer private pay, and they also are always operating on a tight margin because Medicare and Medicaid reimburses for services at a lower rate than private pay. So when there's private pay dollars, a private pay patient that's brought into the system, it makes the providers of care very, very happy. It helps raise the level of care for everybody because it brings more dollars into the system, which improves quality of care, quality of personnel, quality of environment. And you as a CSA who's helping to facilitate that are going to be looked at as a valuable, trusted resource that they're going to want to partner with, that they're going to want to work with, because you're bringing private pay patients and understand the importance of private pay and the variety of options that are out there. Lastly, for the taxpayers, and that's you and me, that's all of us. When somebody goes on to Medicaid, we're paying for that. So states, political leaders are doing all they can in looking for options and ways to make sure families and people are being informed, are being told, or are getting access to private pay ways to pay for care and delay the need to go on to Medicaid. Because if you delay the need for people to go on to Medicaid or the use of Medicare, you're saving dollars for taxpayers, you're saving dollars for very stressed state budgets, and private pay across the board for the consumer, for the provider of care, and for everybody in general is the better option. It's the first option that people should be looking at, not the last option. So I'm going to stop there and turn over to see what kind of questions we may have from our audience.
Thank you, Chris. Our first question for you is, how does the deal differ when looking at a term insurance policy versus one with accumulated cash values?
Sure. In converting a life insurance policy into a long-term care benefit plan, It is not a matter of the cash value that determines what the value of the policy's conversion is. That's actually something known as conversion value. It's determined by the death benefit. So what we see a lot of will be people with, let's say, a $200,000, a $300,000 term life policy or a universal life policy. Obviously, term life doesn't have any cash value in it. Universal life policies can build up cash value. What is being looked at is the death benefit and the care need. And so it's a percentage of the death benefit that they're going to receive. And let's just say, for round numbers, they were going to get 50% of their policy, and they had a $300,000 term life policy or a $300,000 universal life policy, and they were getting 50%. Well, they would be getting $150,000. They would transfer the ownership of the policy, and they would no longer be responsible for making any premium payments. And that $150,000, based on the death benefit of the policy, is going to go into their benefit account and start making payments for their care. Now, as long as they're receiving payments for care out of the account, they're private pay. It is, though, a Medicaid qualified spend down. So let's say they went through that money over a 3-year period. As long as all their other assets were dispositioned appropriately, they could then transfer over to Medicaid to take over, but you would have delayed their need to go on to Medicaid for 3 years. Now, vice versa, if they were to pass away, and let's say there was still $100,000 in their benefit account, well, that $100,000 is then going to transfer to whoever they've named as their account beneficiary, just like a policy beneficiary. But cash value is not what has an impact on what they get for their policy. It's the death benefit. Next question.
The VA pension in New Mexico has experienced financial limitations that make it very difficult for seniors to be awarded the benefit. The VA will not disclose the monthly income level needed to apply. Do you know what the monthly income limit might be?
I don't, on a state-by-state basis, I don't. But the best thing to do would be to contact the Veterans Administration to get clarification from them. That is public information. There's no reason why that would be held or kept from anybody. That would not be allowable. So if at the state level there's some kind of block going on, I would advise going to the federal level, call the VA, and call the Veterans Administration in Washington, D.C. You're going to be dealing with a little bit of bureaucracy. I'm sure you're going to be on hold for a little while listening to some great on hold music, but you will get the answer to your question, because that's public information. It can't be held from anybody.
On reverse mortgages, people forget the interest accrues for the life of the loan and causes negative amortization in many cases. Is this correct?
Well, that's correct. What we always advise people to understand about a reverse mortgage is, unlike it can be advertised, this is not free money. You are paying money. There's interest, there's fees, and that interest does compound year to year, and you have to pay. It is going to be all paid back. The idea is you're paying it back out of the sale of the property once either you move out of the property or you pass away. And remember, as I said, you have to be living in that property to keep the reverse mortgage from needing to be paid back, but interest is accumulating, there's fees, there are costs associated with it. So no one should ever mistake a reverse mortgage for being free money. It can be a good value, and it can perform the right function at the right time, and you do not need to be making any payments back as long as you are living in the home. But once that circumstance changes, it does need to be paid back with all interest and fees included.
Is the LTC benefit plan simply a viatical settlement?
It's actually different than a viatical settlement. It uses a viatical life settlement, viatical settlement as part of the transaction, because you're transferring the ownership of the policy for consideration. So in that regard, for that portion of the transaction to fund the benefit account, it complies with life settlement and viatical regulations on a state-by-state basis. But it's different. In a life settlement viatical, a person is going to receive a lump sum of money, and the national average, industry average for a life settlement viatical is somewhere in the mid-high teens as a percentage of death benefit. The long-term care benefit will work with a much broader array of life insurance policies. We'll work with a smaller size policy. It will go as low as a $50,000 death benefit for any kind of policy that will qualify. And then those funds, which this is also a tool that's used to address an immediate need for care, so it moves quickly. The transaction is designed to go from start to finish in 30 to 60 days. And the funds then are transferred into the protected account that will hold and protect that money and will only use it for long-term care, which protects its tax advantage status. So there are a number of differences between a life settlement and a long-term care benefit, but to fund the long-term care benefit, it requires transferring the ownership of the life insurance policy, and therefore, for that element of the transaction, it does comply with life settlement and viatical regulations in all states where they apply.
Does the individual have to meet any criteria, such as needing assistance with 2 ADLs?
To qualify for the long-term care benefit? No. Each circumstance is very unique. So unlike sort of the cookie cutter approach of a long-term care insurance policy where, it's this, this, and this, and either you do or you don't qualify, the underwriting to enroll in the long-term care benefit goes a little more into care need, circumstances, potential longevity of the individual, what type of policy, what's the death benefit, what's the premiums. So it's a different approach to qualifying and a broader range of services that will qualify. I mean, the long-term care benefit plan will actually pay for family-provided home care, whereas many long-term care insurance policies won't pay for any form of home care. So it's a much broader range of services that the long-term care benefit plan will cover. It's much more flexible because you can change the monthly amount as your care needs change, and you can change where the care is being provided and where the monthly payments are going as the care needs change as well. So some real differences, a lot of flexibility in the program and how to qualify for it.
You mentioned several forms of long-term care that are covered by the different forms of funding. Are home modifications to promote accessibility and mobility covered as well?
I know the long-term care benefit plan will cover that. It will cover the purchase of specialty beds, ramps, rails, all of that will be covered. Most long-term care insurance would not. The senior living loans, for the most part, would not. The veterans benefit is very specific in that the payments have to be made to a care provider. So across the reverse mortgage, you could use those funds for anything you want. So in terms of doing things for an in-home environment, it would be a reverse mortgage and the long-term care benefit plan. That would be the two of the primary options that would do the most to give you the most flexibility to be able to do something to in-home improvements like that.
If someone converted their life insurance to a benefit plan, are you saying it could delay spend down for Medicaid?
Well, no, it is a spend down for Medicaid. When you do that program, you are delaying going on to Medicaid. You're not on Medicaid. You're private pay. So it's a Medicaid qualified spend down. So let's say, and this happens all the time, people who use the program, let's say they're on it for 2 years, as they're getting to the end of their benefit period, let's say in the typical countdown's about 90 days, although it can be longer if the family needs, they will start to apply for Medicaid, and if the last benefit payment is in April of this year, you could then shift to Medicaid in the very next month of May. So it's not that it delays a spend down. What it does is it delays going on to Medicaid, and it is a spend down while you're using the program.
Is the LTC benefit plan spending always tax deductible, or is it based on how it was spent? I thought the IRS had certain rules.
No, that's right. It's based on how it's spent. It has to be spent on care. If the money is being spent on anything other than care, then it would not get that same tax advantage treatment. And also, if there's a remainder in the account that transfers to the family, and that happens, people pass away, there's still a bulk of money in the account, that will transfer to family members tax-free as long as they're underneath the estate tax minimums, which are in the neighborhood of $4.5–5 million. So as it is all impacted by the nature of the person who has enrolled in the program, and by definition, they're always considered chronic, if not even terminal, but typically most likely chronic. And because the funds are only used for care, it preserves their tax advantage status.
At age 65, is it economical to purchase the life insurance option versus LTC?
Well, that's all going to be a factor of underwriting, but typically you are going to pay less premiums for a life insurance policy than you're going to pay for a long-term care insurance policy. And if you have a life insurance policy, you have the advantage of death benefit coverage until you got to a point where you needed long-term care and decided to convert it. You would also want to look at what's known as hybrid policies, and there are insurance companies today selling life insurance that can be converted to long-term care coverage, somewhat like an accelerated death benefit rider, only this is an accelerated long-term care rider, as it were. But those can be very expensive policies, but they are becoming more popular out there. But if you're going to compare a straight life insurance policy to a straight long-term care insurance policy, somebody being the age of 65 and still healthy enough to qualify to enroll in both, chances are you're going to get a cheaper premium with a life insurance policy, have the advantage of the death benefit coverage until such time that you would convert it into a long-term care benefit plan.
Can someone convert their own policy in order to help a senior?
You would need to have the liquidity. There would need to be liquidity to convert it. You would have to know where is the money coming from, and you would have to do it in the right way so as not to do something to potentially violate asset transfer rules. The reason that the long-term care benefit is a Medicaid qualified spend down is because the policy is being sold for its full fair market value to a third party, and the funds are then going into a sequestered account, an irrevocable FDIC insured account that can only be used for long-term care spending. If somebody were to do it on their own and not quite get all of that right, you could potentially expose yourselves to unexpected tax consequences and unexpected, unintended Medicaid eligibility problems. So it typically is going to serve somebody better to work with a third-party institution to do it than to try and do it on your own. But there's no legal prohibition from somebody doing it on their own. You would just need to be expert at how you did it so as not to cause yourself unintended problems.
If one spouse is living in the home and the other spouse is living in a nursing home, do you have to sell your house if you've done a reverse mortgage?
No, if a spouse is living, if a spouse is still living in the home, then the reverse mortgage does not have to be paid back. It's once the reverse mortgage has to be paid back once both are out of the home.
And we still have lots of questions coming in, but this will be our last question that we'll do during the Q&A. How long do you have to keep a life insurance policy before you could convert it to the benefit plan?
The typical period of time is 24 months. You want to, for just about every insurance policy sold, there's a 2-year contestability period where an insurance company could deny the claim. But and typically the people that would use the long-term care benefit approach are people who've owned their life insurance for many years. But the typical threshold, minimum threshold, would be 2 years of the policy being in force.
Well, thank you so much for joining us for this CSA webinar, Private Pay Funding Options for Senior Care with Chris Orestes.